Hello, investors and traders, and welcome to the weekly market report with the Market Guys. I'm AJ Monty. This is a one-year daily candle chart of the Dow Jones Industrial Average ETF, ticker symbol DIA. And as I do each and every week, I left my lines on the chart from the previous week's report, so you can see just how accurate our forecasts have been, as well as the value of technical analysis being used as a forecasting tool. So as I zoom in here, let me just review what we talked about last week. This line right here was drawn in an upward direction where I said the Dow would most likely rally up early in the week and then pull back towards the end of the week. And if you look more closely, you'll see that yesterday, which was Thursday the 30th, we came within pennies of hitting my target, which is the end of that line, and today we finished the job by completing that pattern of moving up and then pulling back. So what does that mean for next week? Well, I'd like to steer your attention down here at the bottom of the chart, which is where we have what's called the stochastics oscillator. I've been talking about this indicator lately quite a bit because it's giving us some clues as to the change in momentum of the market. And this blue line, which is known as the %K, has now crossed down below the D line, which is that red line, and that's a sell signal for a particular stock, or in this case is the general market being the Dow Jones Industrial Average. And so for next week, I do believe that we're going to continue lower in an attempt to pull back to the 20-period moving average, which is this blue line here. There is still an open gap that was left on Monday, and there's another gap below the market down here around 252 on the diamonds, which would be roughly 1/100th of the Dow Jones Industrial Average itself. So if this gap fills at 252, that would bring the Dow to 25,200, and that would be a significant pullback over the short term. Now, keep in mind that when gaps fill, that happens generally about 80% of the time. After the gap fills, we see another 80% of the time where the price will reverse from that gap fill point. So we have to keep an eye on that gap, as it's a price magnet right now, drawing the price lower. But once that gap fills, we could very well see a bounce at these lower levels. So that's my forecast for the Dow. Now, if we look at the spiders, which is ticker symbol SPY, this is the S&P 500 ETF, I said that we would most likely rally, with this line being what I drew last week, the end of the line being my target. We not only rallied, but we surpassed my target. And you can see right here, again, the end of the line being 289.19. And that's right where the market had dropped to the low point today on the 31st of August. Now, what does that mean for next week? Well, again, we have a crossover in the stochastics. Let me show you this scale on the right hand side from 0 to 100 down here. Anything over 80 on the stochastics is considered overbought, but when we get across of these lines over 80, that's a sell signal. So for next week, I'm suggesting that we will pull back just about this far, which would most likely fill this gap, and then we'll have to reevaluate the markets from there. So that's the S&P 500 ETF, known as the spiders. Now I'm going to hop to the VIX. The volatility index is a leading indicator for the S&P, and it's a contrarian indicator as well. If you notice, this line right here is what I drew last week. This line was added on early in the week as I was presenting to a group of investors. So those who subscribed to the weekly market report did not see this line, but if you participated in my web seminar, you would have seen that. And the end of this line was my target for the VIX. Now that the VIX has hit that line right there, that target, what does that mean for next week? Well, if you look, the momentum indicator on the stochastics is still showing an upward direction. We haven't had a cross. We had a cross early on in the week, but it looks to me like the volatility index, the momentum is still going higher. So we're probably going to see higher levels on the VIX next week, which again is contrarian to what we would expect in the S&P. So if we're seeing a potential rally in the VIX, we're expecting the S&P to drop, and we already talked about that. So that's my forecast for the VIX for next week. Now, hopping right along to the Russell 2000, this is what I drew last week, and you can see as I zoom in, we did rally early in the week. We did not pull back yet on the Russell 2000. I have mentioned this several times that the Russell 2000 does not always follow the Dow and vice versa. In fact, today on the 31st, we have a bullish engulfing pattern for the Russell 2000. So for next week, I'm just going to really duplicate these lines. I'm just going to move them over. I do believe that the Russell 2000 could rally early on in the week. And remember, next week, because of Labor Day, Monday the markets are closed, so we'll have a shortened trading week next week. So Tuesday and Wednesday, I'm expecting a little bit of a rally, and then I'm expecting the Russell 2000 to pull back. So I'm duplicating this right here, just moving it over to the right. I'm going to erase this line right here and erase this line right here. Ultimately, I do believe that we're going to pull back to this 20-period moving average. The K line is just about touching the D line, so when these cross, we're most likely going to see more of a reaction in the Russell 2000 coming into next week and towards the end of next week. So finally, let's take a look at the Qs. This is the NASDAQ market. Last week I said we would most likely rally, and I said that we would most likely break out over resistance. However, I thought we would pull back towards the end of the week. We have not done that yet. So I'm just going to erase that line right there, and I'm going to move that on over to the right here, where I think next week the Qs could pull back to what used to be resistance is now going to be support. So I'm going to extend this out to the right, just like that. And keep an eye on this one because role reversal does take place. And what that means is that the former resistance right here is acting like a ceiling. So when we break out or over that ceiling level, we'll most likely pull back, and now the former ceiling will act as support. Notice the K line here in the stochastics starting to move lower, telling us that there's a shift in that momentum. Yesterday, Thursday the 30th, we had a doji, a perfect doji, which is usually a sign of indecision that we generally see at pivot points. Notice back here, we saw a doji, market pivoted lower. Back here, we saw two dojis back to back. The market pivoted lower. See back here, very, very close to a doji, market pivoted lower. That's known as a spinning top. Spinning tops and dojis are more or less related to one another as cousins, I would say, as a sign of indecision. If you'd like to learn more about what we do at The Market Guys, just visit us at themarketguys.com. Click on the video tab. That's at the top of the page, and that'll bring you to our video library where we have short videos called Market Shots. You'll learn the lingo, you'll learn our strategies, you'll learn price patterns, and we make this available for free to the general public, so we add value to your trading day. So thanks for following us. Have a great and extended long holiday weekend, and we'll talk to you next week. So long.
This video segment is a small part of what the Market Guys offer through their educational products and services. If you are interested in any of our Trade Alert services, or you would like more information about our one-on-one mentoring program, simply contact us at info@themarketguys.com.